The expected boom in European infrastructure projects over the next 10 years has private markets looking to capitalize on the opportunities, with U.S. asset management giant Apollo set to enter into one of the UK's biggest deals in this space. Apollo has committed to provide a £4.5 billion loan to French utility EDF, primarily to finance projects in the UK, most notably the Hinkley Point C nuclear power station. Now, this unsecured lending will see Apollo provide an investment-grade debt financing package at an interest rate below 7%, according to a CNBC source. The transaction represents one of the largest sterling-denominated note issuances on record. According to Apollo, the nuclear project has faced controversy and rising costs, and with tensions between China General Nuclear Power Corp and the UK government leading to CGN pulling funding back in 2023. You may remember, leaving majority owner EDF to pay for the project alone. Costs have surged toward £48 billion amid supply chain headwinds and labor shortages. Well, we are very happy to have Robert Seminara with us, partner and head of Europe at Apollo Global Management. Robert, thank you so much for joining us in studio.
Thank you for having me. It's a pleasure to be here.
It's great to be here, and we're keen to talk all things private markets, but let me kick off with this latest deal around Hinkley nuclear power station in the UK. This has been, a huge story over the years, and I'm just keen to hear how this deal came together. I think this is maybe the biggest sterling-denominated private credit financing. So this is a massive deal for the power station and massive for the private sector in general.
Yeah, no, this is a very important transaction for us, a very important transaction for EDF. We've maintained a relationship with them and many corporates over the years. We're obviously aware this is a very prominent project that they're working on, and the reality is this financing will get it to the point where it will be fully developed finally. And important, this ultimately will power 6 million homes in the UK. It's a plant that should last 60 years, and it'll be carbon neutral. So when you think about green transition and the spending that needs to happen, being able to back EDF in this transaction is important to us, and the size of it matters, right? It's a £4.5 billion transaction. We have large funds, and we're able to partner with EDF given the scale of it.
When is it going to be fully operational?
It's a couple of years till it will be operational, but it's fully financed to get to that point.
And what does this say about the broader nuclear space? We had a guest on earlier who said nuclear is back on track. You look at Japan, you look at France, and now this deal coming through. What is your sense here? And is this an area where you're looking to deploy more? I know Europe is a huge focus for Apollo right now.
Yes, Europe is definitely a huge focus for us. We're looking to grow. And when we think of the big investment areas, clearly the transition to green energy is one of those areas where we're going to lean in very heavily. Our capital is, again, we have scale, which matters for these big projects, but we also have duration. We have committed funds that can last multi-year. We have also a retirement services balance sheet, which wants to invest on the long term. And so when you think about the development scale of these projects and the duration it takes to both develop the project and then get cash flows out of it, the long-dated nature of our cash flows is very apt for what they're trying to accomplish.
Can you just talk to us a little bit about the investing landscape? Because we were just talking about a company before effectively held on to an asset for a long period of time before exiting, and that seems to be what we're hearing more of in the industry, that exits haven't happened as much as they would have previously. First COVID hit, more volatility around other conditions as well, trade, risk off around the Middle East, Ukraine. What happens now if you want to buy assets in terms of those valuations? Is it just easy because you've got a ready balance sheet, or you're in the same situation of everybody else? You haven't done as many exits as you would have liked.
Look, it's never easy. First of all, I'll say that. It's always a little bit tricky to do these transactions. But that being said, look, the M&A environment has been slow for the first half of the year, right? When there's uncertainty, sellers don't want to launch a sale process just simply because they feel like they won't get the price they're expecting. So you've seen a lack of transactions. And buyers have a tough time putting a price on something when there's geopolitical uncertainty, there's uncertainty around a trade war. So you have definitely seen a slowdown during the first half of the year. We think following September, you'll see a pickup. I think the financing markets are wide open right now. If you talk to the investment banks, they're preparing materials, and they think that people now can quantify what's going on out there, that transactions will ultimately pick up. We've been fine in terms of exits. In the last month and a half, we've done an IPO of Lottomatica, we've done an IPO of Aspen. We recently, actually today, announced the sale of one of our Japanese businesses. So we've been able to return over $2.5 billion of capital to our investors. So if you have the right company and it's positioned correctly, you can exit. But there's just an incredible amount of portfolio companies that need to be exited.